Investing is rarely about how much money you make. It is almost entirely about how much money you actually keep. Most retail investors slowly bleed their wealth away without even noticing, thanks to two quiet drains on their capital: hidden fee structures and their own emotional reactions. The most common trap is the so-called free financial advisor. You might not pay them anything up front, but their commission is quietly baked into the expensive, complex products they sell you. You end up paying them directly from your future returns. The alternative is the do-it-yourself approach. You buy a low-cost ETF, which is a bundle of hundreds of individual stocks designed to track the broader market to save on those advisor fees. But then you run into the second drain. When the market inevitably dips, you are entirely alone, making it incredibly easy to panic and sell your assets at a loss. This leaves the average investor stuck between a rock and a hard place. Either let the financial industry slowly siphon away your money, or risk destroying your own portfolio through sheer decision exhaustion. Beating this dynamic requires completely removing human guesswork and hidden costs from the equation, replacing them with a strict, transparent system. Platforms like eToro offer a distinct structural advantage through a feature called CopyTrader. It allows you to perfectly mirror the exact portfolios of verified, successful investors in real time, completely bypassing traditional management fees. This brings us to a specific case study: an investor operating under the handle @Lukaszko81, or Lukasz Novotny. He has built a strategy explicitly designed to generate quiet, reliable returns instead of loud marketing hype. His core defensive strategy relies heavily on extreme tax efficiency. By committing to hold his stock positions for more than a year, he legally shields his capital from heavy short-term taxation and entirely eliminates the administrative headache of filing complex tax returns. Frictionless systems build wealth by shielding capital from taxes, fees, and emotional panic. The scale of Novotny's operation is substantial. He currently sits in the top 10 of all copied investors in Slovakia, with a verified base of 289 individuals trusting his moves with their own capital. That trust is backed by a highly consistent historical baseline. Over a 10-year period, his portfolio has maintained an annualized return of over 17%. This visualization shows the exact geographic distribution of his investments. You can see a massive concentration right here in the United States, which makes up a deliberate 62% of his entire portfolio, acting as the primary engine for his returns. Looking inside that U.S. allocation, the structural load is carried by three main pillars: finance at nearly 25%, followed closely by non-energy minerals and electronic technology. Those specific heavy-hitting assets also provide a defensive income layer. 55 of his positions pay out regular cash dividends, creating a solid 2.45% yield that acts as a safety net even when stock prices stall. While the surface of the portfolio is grounded and defensive, the recent data shows a distinct shift in how it behaves. When we dig into his performance over the last 12 months, we find a textbook hockey stick progression. His historical steady growth suddenly spikes straight up. For years, this portfolio was essentially tracking the broader market. When the market went up, his returns went up. When the market dropped, his returns dropped right alongside it. In finance, we measure this mirroring effect using a metric called beta. Beta calculates exactly how violently a portfolio reacts to the overall market's crashes and volatility. A beta of 1 means you take the exact same hits as everyone else. This graph tracks his risk versus his reward. Notice how the two lines move together until last year. Suddenly, his beta dropped to 0.23, meaning his portfolio barely registered the broader market's drops, while his actual returns shot almost straight up. He decoupled his wealth from the crowds while maintaining his upside. A sudden spike in returns like that immediately raises a red flag. It is very easy to look like a genius when the entire market is having a profitable year. To test for luck, we use the information ratio. The information ratio is a mathematical lie detector that measures how much of a portfolio's outperformance is due to systematic skill rather than random chance. Novotny's historical score was a modest 0.27, but in the last year it jumped to 1.29. The data also shows he built a mathematical shield. His Sortino ratio, which measures downside risk, hit 10.0. That is essentially the ceiling for this metric, proving that while the portfolio captures upward momentum, Its drops are incredibly shallow. Finally, we look at his Jensen's Alpha, a metric that calculates how much an investor beats their expected risk-adjusted returns. His specific stock selections are currently outperforming expectations by over 33%. The metrics track a transition from a standard retail approach toward a specialized quantitative strategy. To survive the modern market, you cannot rely on gut feelings or expensive advisors. You have to find a cold, unemotional system and fiercely protect your capital from unnecessary fees. Please note that your investment is at risk. Past performance is not indicative of future results, and utilizing CopyTrader does not amount to investment advice. Real wealth does not need loud marketing. Real wealth is silent, systematic, and strictly measured.